you. Thank you to everyone who has joined this seminar today, and I'd also like to thank the organizers for giving me the opportunity to present this paper. We've been working on this with Professor Jianfeng Hu at Singapore Management University, as well as our two Korean co-authors, Gilbert Park and Doo-Jin Yu. And before I begin, I would just like to note that we are currently revising the paper, so some of the results that I will show you are new, so they might differ a bit from the version of the paper that we uploaded on the VDW website. Anyway, so what do we do in this paper? We use account-level transaction data to look at trading styles and profitability of retail and institutional investors in a leading derivatives market, namely the Korean options and futures markets. We all know that options expand the trading opportunity set, while stock investors only get linear payoffs. Options traders can construct various different structures to gain exposure to both the underlying price as well as volatility. So it's important to look at the options market since it provides many different opportunities to use various strategies with different complexity. So the question we want to ask in this paper is, does the complexity of the trading style that an investor uses reflect his financial knowledge, his trading skill, and his level of sophistication? To give you some examples, for example, naive investors may trade options like they trade stocks. So they might view the options as leveraged stocks and just speculate on the underlying stock price movements. And this can be achieved with very simple positions like long calls or long puts. And on the other hand, we might expect more sophisticated investors to use options to construct more complicated strategies. For example, hedged positions or strategies used to limit risk exposure like bull or bear spreads. Or they might also use options to trade on or hedge volatilities with strategies like straddles, strangles, or butterflies. Now, all of that being said, we do not really know how investors use options in reality. There is very little evidence compared to what we know about equity trading, and this is largely due to data limitations and the complexity of options trading. Of course, there is the paper that I am sure all of you know by Lakonishok, Lee, Pearson, and Poteshman, and they provide a description of the US options market activity, but the account level data that they use is limited. It's only a subset of retail investors. Similarly, for the second paper that I list by Lee, Subra, and Yang, they study trading patterns during the Chinese warrants bubble. So the first issue in this paper is that they only look at a limited time period during a bubble. So there is the issue of external validity, but also their account level data comes from a single brokerage, and it accounts for only about 3% of the aggregate market volume. So this is only a small portion of the total market trading. They also have very few institutions in their data. There are also other studies that I have listed here of options trading in international markets, and all of them are undermined by various data issues. So some of them have only a small sample of options, or a lot of them lack account level data, or they are not able to compare institutions and retail investors. And in comparison, our study uses a complete data set for the whole market. It's a very comprehensive data of account level transactions and positions in both options and futures. And this really allows us to study in detail the trading styles and strategies of different types of investors. So we want to use this data to answer these questions. How do investors use options and who profits from trading options? And the first thing we do is we compare institutional versus retail traders. But more importantly, we want to look at trading styles. And we want to use the complexity of trading style as a sort of ex-ante measure of investor skill and level of sophistication. For example, for the paper by Lee, Subra, and Yang, their measure of skill is based on performance, but this is an ex post measure. In contrast, we want to have an ex-ante measure of skill and then see how that relates to profitability. So here is a summary of our findings. We find that retail investors tend to stick to one trading style. About 70% of them predominantly hold simple positions like long calls and long puts. So in other words, retail traders trade options like stocks. In contrast, institutional investors are more likely to use multiple strategies, including more complicated ones. And if we look at the classic option strategies that are usually listed in derivatives textbooks, then out of those, we see that volatility trading is used more often than the others. And who profits from trading options? First of all, we want to show that trading style matters. A trading style significantly affects investment performance. In particular, retail investors using simple strategies, they lose to the rest of the market. The most profitable trading styles for both retail and institutional investors are volatility trading and Greek neutral strategies. So those investors who are able to use more complex trading styles, they profit more regardless of whether they are a retail investor or an institution. Let me give you some details about the Korean index options market and our data. We obtain data of all options and futures trades in Korea with account ID between January 2010 and June 2014. So it's 4.5 years of daily observations, 4.5 years of data where we have account level transaction data with the millisecond timestamp of each transaction. And the data contains detailed information about both counterparties to each transaction. So we have the flags for who is the buyer, who is the seller, whether it's a retail investor, an institution, what kind of institution, and other details like country of domicile, etc. The underlying security is the KOSPI 200 index, which is the representative index of Korea. So it's similar to the S&P 500 in the US. And the Korean market is one of the most active and liquid derivatives markets in the world. The trading volumes are really comparable to those in the US. There is about $1 billion traded on an average day. And these derivatives markets, they are available to investors globally. So we find that between 1/3 and 1/2 of all the volume is generated by foreign institutions. So these are likely to be large institutions that trade not only in Korea, but all over the world. So our findings may have important implications beyond the Korean market. And another detail I want to mention is the market is constructed as an electronic limit order book, and there are no designated market makers. Here are some summary statistics. We have 122,620 accounts that we use in our analysis. Most of them are retail investors, so there is high retail participation in this market. But there is still a significant number of institutions. And even though they are smaller in number, they generate much more trading volume. So here I have plotted the average daily options trading volume of all investors, all investors who are institutions and all who are retail. So the institutions generate about twice the trading volume on an average day. And when we compare liquidity takers and liquidity providers, we see that institutions tend to take more liquidity than they provide, while the opposite is true of retail investors who tend to be the liquidity providers. So how do investors use options? We start by looking at the strategies in account days. So in the analysis here, we have account day observations. The first thing we do is we separate investors into day traders and position holders. For day traders, we define them as those accounts who only trade intraday, so they never hold a position at the end of the day. As for position holders, we can observe all the different option contracts and futures contracts that they hold at the end of each day. And out of those positions, I extract the strategy that they are using and categorize it into the following categories. First, we have combinations of options and futures. Those account for about 6% of all account days. And futures provide exposure to the underlying market, and options can be used to hedge that exposure. But when we look at the traditional strategies that are used for hedging, such as covered calls and protective puts, we see that they are only a small fraction of all the combinations of options and futures. And the rest are other combinations. From those, we extract the Greek neutral ones. So this means positions that are delta hedged and vega hedged. Next, we have simple strategies. Here, simple strategies refer to directional exposure from holding only one type of option contract. So for example, we see that the account is holding only long calls or only long puts, etc. So these may be thought of as naked options in the sense that they are not combined with any futures. Of course, index options can also be used to hedge ETFs. And even though we do not have the account level data for ETFs, we know that in the Korean market during our sample time period, ETF trading volumes were quite low, so it's unlikely that these options are used for hedging ETFs. Instead, we argue that they are more likely to be speculative strategies rather than hedges of the underlying index. And this assumption is supported by some other literature that shows that hedging is not a major motive for trading options. So we can see that these are a significant fraction of all the observations. They account for more than 55% of the account days. Most of them are positions in long puts and long calls. And if we look at the institutions and retail investors separately, then we see that institutions also tend to hold a lot of short calls as well as short puts. The next category we look at is volatility trading. So here we include straddles, strangles, and butterflies. These account for 16.5% of all account days. We separate them into the different strategies, and we also look at long versus short vol. And here we can see that strangles are more popular, while straddles and butterflies are almost never used. We also extract the long and short combinations. So these can be different combinations of straddles and strangles that the account is holding. And again, if we look at institutions versus retail investors separately, the difference is that the institutions are holding more short vol positions. So there are a lot of short combinations and short strangles. while the retail investors tend to use both short and long vol strategies about equally. And next we have spreads. So here we include bull-bear spreads. They are the largest fraction. Also synthetic stocks and calendar spreads. But those are a very small percentage of all observations, so we do not look at these strategies further. And finally, we have the remaining category others, where any positions that do not fall into the previous category. And from those, once again, we extract the Greek neutral positions. So these are delta and vega hedged options positions, and they are 6.5% of all the account days. So these Greek neutral positions, we see that they generate large volumes and they hold a significant portion of the total open interest in the market. They hold complex combinations of multiple different contracts, which don't correspond to any of the previous strategies, and they also hedge all of their risks. So it looks like they are likely to act as market makers or arbitrageurs in the market. And if we look at the distribution, we see that institutions use a lot of combinations of options and futures. A lot of them also fall into the others category, and they also use all of the other strategies as well. For retail investors, they mostly use simple strategies, but we also see that some of them appear to be more skilled, and they are also using volatility trading and the other more sophisticated strategies. Next, we want to look at the dominant strategy of each account. So for day traders, the definition is the same. They are the accounts that only trade intraday and never hold positions at the end of the day. But for position holders, one account can hold different positions on different days. I mean, they can hold positions in different strategies each day. So we want to extract the dominant strategy of each account. So to give you an example, if at least 60% of an account's end-of-day positions are positions in simple strategies, then we will define that account as a simple strategy trader. So we use this 60% cutoff to define the dominant strategy of the account. And using the same 60% cutoff definition, we define day traders as those who hold volatility positions at least 60% of the time, and Greek neutral traders are the accounts who hold Greek neutral positions at least 60% of the time. And again, we have the remaining category others. In this category are accounts that have a dominant strategy that we are not able to recognize. So it doesn't fall into any of the other categories. And there are also accounts who switch a lot between the different strategies, so they do not have a dominant one. And we can see that for institutions, a lot of them fall into the others category. And they also use all of the other strategies once again. For retail investors, almost 70% of the accounts are simple strategy traders. So it appears that most of the retail investors trade options like they trade stocks in a very simple way. But again, there is a small number of accounts that are able to engage in more sophisticated strategies.
Okay, so Antonia, before you get too far, can you maybe answer a couple of questions?
Sure.
Okay, from Steve Figluski, how do you determine that a particular position is a strangle, say, rather than two individual trades executed at different times? Similarly, how do you split up a complex position into named positions like straddles, covered calls, etc.? The pairing of contracts in such an exercise is not obvious.
Okay, so for straddles and strangles, when I define a straddle or a strangle, I look at the end of day position of the account. So for example, if they are holding two different option contracts, a call and a put with the same maturity and same strike price, then I know for sure that this is a straddle. If they are holding more than two different option contracts, then it becomes more complicated. So these would fall into the combinations. So what we do here is we look at the types of exposure that the account has. So for example, if without looking at the different option contracts, if we see that all of the positions of the accounts are positions in long calls and long puts, and these are the only types of exposures that the account has at the end of that day, then we can be sure that this is a combination of long vol strategies.
So I'm not sure that let me try again. I'm not sure that I might be wrong about what I think Steve's point is, but let me try again. Let's suppose I write a put at the beginning of the day. And then the put, then the stock price moves, so the written put is way out of the money and almost worthless. And then I write a call with the same strike price later in the day. And what I've really done is written a put. It was worthless, so I've forgotten about it. And then I've written a call. So what I've really done is two simple trades, but you would count that as a straddle, as a volatility trade.
Yes.
I think this is what Steve's question is about.
Yes, the way we do the analysis, that would be counted as a straddle. We don't currently look at the moneyness of the options.
Okay.
Of course, we could do that, but that would be quite complicated. And I'm not sure how often such positions would be encountered in the data.
All right. Then a different question from Che Orthanoli. Do all account holders have the same ability or privileges to trade all different strategies? In other words, is the choice of trading strategy due to the available trading strategies that each account holder can execute?
Are you referring to the regulations in the market, whether they are allowed to trade all strategies?
I think so, yes.
Yes, then the answer would be yes. All accounts are free to trade any strategy.
Okay. I'll clean up all the other questions here. So if from Dimitri, if a retail investor trades through a broker, of course, do you identify each of the separate retail accounts, or is it are they all grouped together as trades by the broker?
We have the separate retail trader accounts. So each account in the data always corresponds to only one investor.
All right. Okay, that's it for now. There are a couple comments in there, but Dimitri will send you the chat later so you can see the comments later.
Okay, thank you. Okay, where was I? Right, so after we categorize accounts by their dominant strategy, Here I also show for each trading strategy or trading style their mean daily trading volume. So we can see that the Greek neutral traders are the ones who trade the most on an average day, followed by the day traders who also generate a lot of volume. For the other strategies, the trading volume is lower, so I suppose those strategies consist more of just buying the options and then holding the position for a longer time. Next, we want to look at profitability. And we start by using the transactions records to calculate a profit and loss for each account in dollar terms, or in this case, in millions of Korean won, over the whole sample period. And we use the transaction prices to calculate profits. Or if a position is held until maturity, we calculate the profit using the final settlement price. So here are the percentiles for institutions and retail investors. We can see that unsurprisingly, institutions are more profitable. And if we look at retail investors, they only start being profitable at the 80th percentile. And if we take the median and we want to see how big that loss really is, we calculate the percentage of the median retail loss of the percentage of the top decile households by household income. And this loss represents 38% of the household income. So these numbers are significant, and we can see retail investors are losing a lot of money. However, measuring profitability in dollar terms, of course, can be contaminated by things like capital constraints or account size, and of course, trading frequency. So what we want to do next is to calculate return. And the way we do that is we take the daily profit and loss in dollar terms, and we scale that by capital requirement. The capital requirements come from the marginal requirements of the Korea exchange. So the capital requirement would be the total premium of long positions plus the margin of short positions. And these capital requirements set options trading different from stock trading, because option sellers do not receive the sales proceeds of the options they sold. Instead, they put down a sizable margin. So by calculating return in this way, we want to take into account this unique feature of margins in derivatives trading. And we argue that compared to a simple return calculation based on price changes, our measure is a more practical measure of profitability because it takes into account the margins. The second part of the equation shows that we calculate dollar P&L from end of day positions separately from the dollar P&L from intraday positions. And we do this because the capital requirement for positions and for intraday trades are different. So as margin settlement is daily, the end of day capital requirement is based on the value of the end of day position. In addition to that, if the investor is also trading intraday, they would be subject to separate different intraday capital requirements. So that's why we separate those two. And we want to emphasize that this scaled profitability measure is the rate of return to each dollar of capital invested in Kospi derivatives. And finally, to have one single profitability measure for each account, we take the mean daily return of each account over the whole sample period, and we also calculate Sharpe ratio. So we take the mean daily return divided by the standard deviation of the returns of the account. So who profits from trading options? Here I will plot the daily mean return of each account, averaged across accounts in each category. So first, when we compare institutions and retail investors, once again, we see that the institutions are much more profitable. Then we look at the different trading styles, and we find that volatility traders are the most profitable on average. Also, Greek neutral traders and others seem to be profitable on average, while the simple strategy traders are losing money. And here I plot the same for institutions and for retail investors separately. Again, for both investor classes, the volatility traders are most profitable. What's interesting for institutions is that whatever strategy they are using, they are profitable on average.
So before you leave these, let me ask a question before you leave these profitability results, because the question is about the profitability results. So from Pat Fish, do you have active retail accounts that behave like some institutional accounts with similar levels of activity? So this question is about whether retail and institutional traders are broadly homogeneous within each group. Specifically, are the larger retail, or institutional accounts different from the smaller retail or institutional accounts, particularly with respect to profitability?
I do not have those results on the slides, but if they differ, then the difference would be mainly in profitability in dollar terms. But once we scale that by the capital requirements, the account size should not matter anymore. That's why here we focus on the return measure. So whether they are a large or a small account shouldn't matter as much.
Well, let me ask a follow-up question. I'm not sure it's the follow-up question that Pat would have asked, but are there some large retail accounts that look and act like institutional accounts? Are there some, or another way, are there some large retail accounts that look like professional traders?
It looks like in terms of strategy, there are, I suppose, especially for the Greek neutral traders, we see that both the institutions and the retail investors generate a lot of trading volumes. So these are a small number of accounts, but they trade a lot and they hold a lot of different option contracts at the same time. So even for retail investors, it seems like some of them are acting like institutions. And the point we want to make is that this kind of trading style, the fact that they can trade in such a complex way affects their profitability positively.
Well, let me ask one last follow-up question, and then I'll let you go on. This is my question. So do you identify traders who look like their business is, liquidity provision, who are playing the role of market makers?
Right. Since there are no designated market makers in this market, we cannot be sure, but we hypothesize that these Greek neutral traders are most likely to be the ones who act as market makers or arbitrageurs, because first of all, the fact that they generate a lot of the trading volume. They hold almost 50% of the end of the open interest in the market. Market makers would usually like to go home flat at the end of the day, but if they happen to hold positions, those positions are very well hedged. Also on the next slide, I show that these Greek neutral traders, when we look at their Sharpe ratio, it's much higher than the other strategies. So it means that consistent with the hypothesis that they are market makers, it means they are making a small profit from every single trade, but since they also take a low risk, they have a high Sharpe ratio.
Actually, do you see their quoting behavior or just their trades?
Yes, we also have the quotes data, but we don't use them in this study.
All right, I should let you go on because I'm taking up too much of your time with these questions. So why don't you move?
Thank you for your questions. So anyway, I wanted to mention here that the simple strategy traders are the only category that we observe that lose money. So they are losing money to the rest of the market. These are the simple strategy traders who are retail investors. On the other hand, institutions, when they use simple strategies, it seems like they're able to gain from them. So this is possibly due to informational advantages. Because such simple strategy directional bets, they are often used for speculative trading or informed trading. So it is likely that the institutions are better skilled at acquiring information. And here are also the Sharpe ratios, and the results are similar. The only difference I want to mention is, again, the Greek neutral traders now outperform the vol traders in terms of Sharpe ratio, because as we know, vol trading, especially short volatility strategies, incur a lot of risk. They have a large downside risk. So in terms of Sharpe ratio, they are a bit lower.
Let me ask one more simple question before you move on. So these are the actual trade prices. So they include any bid-ask spread costs and price impact, but do they also include brokerage commissions?
No, we do not have the brokerage commissions. Okay, here I also, in the graphs we see means, and here I also show the percentiles for mean daily return and for Sharpe ratio for the different strategies. And I just want to note that for simple strategy traders, they are losing money up to the 80th percentile. They only start to make a profit at the 90th percentile. While for Greek neutral traders, when we look at their Sharpe ratio, it's always positive above the 20th percentile. Next, we look at regressions. So in the first three regressions, we regress mean daily return. And in the other three regressions, we regress Sharpe ratio on a dummy variable for whether the account is an institution, as well as dummy variables for the dominant strategy or the dominant trading style that the accounts are using. And the results are consistent with what we saw in the graphs. Simple strategy traders always have very negative significant coefficients, while vol traders and Greek neutral traders have positive and significant coefficients, with the vol traders being the most profitable in terms of mean daily return, and the Greek neutral traders being the most profitable group in terms of Sharpe ratio. And I just want to mention briefly that we do a lot of robustness checks in the paper, Most importantly, we look at risk-adjusted return. So we adjust for the market index returns as well as for implied volatility. So to adjust for the volatility risk premium. And the results are the same. Qualitatively, they are consistent. We also try different cutoffs for the definition of dominant strategy. We also do a panel regression, and in all cases, the results are consistent. Next, we want to look at regressions in subsamples by investor class. So we look at the institutions and retail investors separately. And again, the results are consistent with the graphs that I showed you. So for day traders, the institutions, for day traders and for simple strategy traders, the institutions are profitable while retail investors lose money, while the volatility traders and Greek neutral traders, they always outperform the other accounts. In this test, we want to look at the profitability from using the account's dominant strategy versus non-dominant strategies. So these are panel regressions for institutions and for retail investors separately, and we regress their daily return on, again, the trading style dummies, and we also interact those with a dummy variable for whether on that day the account is holding their dominant strategy or a non-dominant one. So for example, for day trade, for volatility trader, if the non-dominant strategy dummy is equal to 1, it means that this account that is most of the time volatility trader, on that day he is holding some other position. And we see that for institutions, whenever they deviate from their dominant strategy, they are underperforming. So they are better off sticking with their dominant strategy. While for retail investors, the same holds for the volatility traders. Whenever they deviate to using another strategy, they lose money. But what's interesting is that for simple strategy traders who normally are unprofitable, whenever they use another strategy, they do better. And next, we want to see whether these trading style effects are persistent. So we split the sample into two parts, the first part being the in-sample analysis and second part out of sample. And we use the 60% cutoff definition to define the dominant trading style of each account in sample and out of sample. And these are transition matrices to show the number of accounts who continue to use the same dominant strategy out of sample, or they switch to a different one. So the diagonal shows those accounts who show out of sample trading style persistence. They stick with their dominant trading style. And we see that the percentages there are the largest for both institutions and retail investors. So it seems like there is indeed a persistence in those trading styles. And we also look at out-of-sample performance persistence. So here the regressions use the trading styles defined in sample, and we check whether those investors, we look at their profitability out of sample to see whether the dominant strategy in sample is related to profitability also out of sample. And the results are largely consistent with our main regressions. So there is also out of sample persistence in performance. And finally, we want to check whether our profitability results are driven by any behavioral biases. So there is a lot of literature, mainly about retail investors. So here we focus on the retail investors. And the literature suggests that they can be rational traders who are often subject to different behavioral biases, and these can lead them to be unprofitable. So we want to check that our trading styles that we define are measuring something else and are not driven by biases. So here we have different control variables for each behavioral bias. For example, overconfidence following Barber and Odin is equal to the average daily trading volume of the account. So excessive trading is linked to underperformance. Then we look at trend chasing. So whether the account, whether the delta of their position is sensitive to the recent index return. We look at transaction costs because these can also influence profitability. Here, transaction costs, we mean the percentage of volume that is initiated. So how much of the account's trading is aggressive versus trading for liquidity provision. We also look at lottery preference, so the percentage of the account's positions that are in long out of the money contracts. Self-attribution bias is the sensitivity of position size to the investor's recent performance, because literature suggests that if an investor performs well in the past, retail investors at least, they tend to believe that their good performance is due to skill rather than luck, so they will continue to trade even more in the future. And finally, we have a control variable for whether the account is a foreign investor, because there is some literature showing that foreign investors that trade in those emerging markets like Korea or China or Taiwan, they tend to outperform the domestic investors. So we see that a lot of the coefficients are negative and significant, so consistent with the literature, the retail investors' profitability is negatively affected by behavioral biases, but the results for our trading styles are still significant, and they are consistent with our main regression. So again, retail day traders and simple strategy traders outperform the other accounts, while the volatility traders and Greek neutral traders always outperform. So to conclude, the main message that we want to show in this paper is that trading style matters, and the trading style complexity reflects investor skills, financial knowledge, and level of sophistication. We show that the trading styles significantly affect investment performance, and these style effects are persistent and cannot be explained by systematic risk exposure or known behavioral biases. Thank you.
Great, thanks very much. At this point, people should feel free to unmute their microphones and ask any questions via the microphone. I'll actually start off though by asking a question from Dimitri that I deferred because I thought it could wait to the end. And so the Dimitri's question that I deferred is, would you expect your results to hold in other options markets outside Korea? And if so, why?
Yes, we do not think that the Korean market is really unique compared to other markets. As I showed you, it's a market that is one of the most active and liquid derivatives markets in the world. There are billions of dollars traded there, so it is important and it deserves attention. And another thing is that a lot of foreign investors trade in Korea. So all of the large players in the investment banking industry, they trade in the Korean market, and not only there, but all over the world. So we would expect that our results would have implications for other markets as well.
All right. All right, thank you. So are there other questions that people want to ask now?
This is Steve Figluski here. Antonia, I love your paper. It's really, really interesting. You've got amazing data. This account level data is fantastic to be able to do the kind of stuff you're doing. So of course I have about 50 questions, which I'm sure Neil will never allow me to ask. I'm trying to pick out the best one or two. One thing that you don't seem to look at is whether what the market was doing at the same time. So for example, if my trade is I buy calls and the market goes up as it has in the United States, I could be dumb as a post and still make a ton of money. Similarly with volatility trading, if volatility stays unusually low as it did in the United States for years, for a number of years until quite recently, people who sell vol look pretty good until every once in a while they blow up and so forth. So it would be interesting, I think, to kind of connect the profit and loss that you're seeing with these different groups to what the market was actually doing at the same time. That's one point. And a second point, then I'll shut up, is that you also have the ability to look at things like technical trading, where you can by connecting what's happening in the market, things that investors might think of as technical measures like trends or like support and resistance levels, you can see how different classes of traders are responding to those things in the market. So I can think of a zillion things that you would maybe like to do with the kind of data you have available, and I certainly encourage you to keep doing it.
Yes, thank you for your comments. And it's true, the data is really very detailed, and there are so many things that we can do with it. And actually, the things I showed you are results generated with only a fraction of all the variables that are available in the data. So we can do a lot more things, and people keep suggesting different ideas. But I suppose we cannot do everything in this paper. As for your first comment about the market movements, it's true we do not look at the simultaneous positions and how the market moves, but that's why we try to do some robustness checks where we do risk-adjusted returns. So we adjust for the market returns, and we also look at the performance persistence. So if, as you mentioned, some accounts just gets lucky the first time, and maybe they are profitable because of luck, then in the future they might be unprofitable, then that doesn't reflect skill. So that's why we do these out of sample persistence tests to check whether our results are really measuring skill rather than luck. But thank you for your comments.
Thank you.
Do you have the trade times?
Yes, millisecond timestamp.
So it might be a lot of work, but you know, returning to Steve's earlier comment about some of the challenges in identifying the strategies, right? You could do something like say, well, it's a straddle if the put and call are executed within X minutes of each other, right? You don't really expect to see them executed exactly at the same time because people might leg into it, but you know, you can use the trade times to maybe do a more precise identification of strategies?
Yes, yeah, we can do that definitely. What we do right now is just to look at the end of day positions. But I think judging by the profitability results, it seems to be consistent with what we would expect to see. So for example, the fact that vol traders generate large returns, but also we find that they incur a lot of risk. So the Sharpe ratio is lower. So I suppose for most of the volatility observations, we are able to extract those. But of course, if the account is holding a combination of a lot of different volatility positions, then it becomes very difficult to extract all the volatility trading observations. So actually the numbers we show for how many account days are using vol trading are a lower bound, I would say.
Can I also add something?
Of course.
Yep.
So I think Stephen and Neil's concern is some maybe naive retail guys just randomly enter a volatility position and then they got lucky because we show vol traders do better. So we are actually not very concerned by that. But of course, it's a great suggestion. We should identify vol trading better. That's a good point.
One question I have about volatility trading is how do you separate volatility trading from Greek neutral trading? It seems to me that, or actually I have a better question about your Greek neutral thing. Do you calculate whether they're Greek neutral or not? I mean, do you have to calculate the Greek letter risks and determine that they are neutral with respect to enough of them or sufficiently neutral, or how do you do that?
Yes, so the Greek neutral positions we extract from any other remaining positions that we don't identify as the other strategies, as well as any combinations of options and futures that are not used for hedging. And the way we do that is we impose some artificial cutoffs on these remaining accounts, Greek's exposure. So if they are in both the bottom 50 percentile by absolute delta and in the bottom 50th percentile of absolute vega, then we identify them as Greek neutral. Mm-hmm. So we realize that these are some artificial cutoffs that it might be better to use a different cutoff, for example. So we also check whether there is a significant difference between the average delta and vega of those Greek neutral positions and the others that remain in the others category. And we find that on average, the Greek neutral positions have, I think, about 0.01 absolute delta, and similar for the vega as well. So very low delta and vega exposure. And the remaining positions have significantly higher delta and vega.
Mm-hmm. Good, thank you. You've calculated the delta and vega and so forth yourselves using Black-Scholes model, perhaps?
Yes, yeah. We calculate them for, I think, for every transaction, and then we take the delta and vega of the end of day position as well.
Mm-hmm.
Okay. Well, thank you very much, Antonia. With some luck, you will not have to do too many of your job market talks during the night like this. It was very interesting, very interesting data